Let's go back to November 27th. This is the date where everything started to crack. The CME, which is the major exchange where silver is traded, actually halted trading right in the middle of the session. Now, when they issued their statement, they called it a cooling failure. They wanted you to believe it was just a technical glitch, like a server overheating or a fan breaking down. But you and I both know that traders who have been in the trenches for years know exactly what that really means. You don't halt a global market because of a fan. You halt it because the system is breaking. Reports are now suggesting that the largest banks in the world have sold a staggering amount of silver, approximately 250 million ounces, that they may not actually own. This is what we call a naked short. It's a promise to deliver metal that doesn't exist in their vaults. And now, the bill is coming due. Someone on the other side of those contracts is demanding delivery. They don't want a cash settlement, they want the physical bars. In the next few minutes, I want to walk you through exactly why Bank of America is projecting a $65 target, and why I personally believe that number might be catastrophically conservative. We need to talk about what happens when the world's most critical industrial metal simply disappears. As of December 4th, we saw silver hovering near $15.65, which is an all-time high. Bank of America analysts are projecting $65 by 2026. But here is what they aren't telling you in those polished reports. The physical metal appears to be vanishing. I'm going to show you exactly who is scrambling behind the scenes, why the banks may be trapped in a corner they can't escape, and the 3 specific catalysts hitting in the next 30 days that could push this price past $70. Let's look at the numbers, because numbers don't lie. By December, silver had gained roughly 101% in a single year. You have to compare that to gold. Everyone loves gold, but gold is only up about 60%. The S&P 500, that's up approximately 15%. Silver has essentially doubled while everything else in the market was just crawling along. And you need to understand the historical weight of this. This is only the second time in history silver has performed like this. The only other year that was better was 1979, when silver surged approximately 435%. Now, skeptics will immediately point to the Hunt brothers in 1979 and say that was market manipulation, and it crashed spectacularly. And they are right about 1979, but this time, it is completely different. This isn't manipulation. This is cold, hard mathematics. Just look at the money flowing into this space. In November alone, we saw approximately 15.7 million ounces of inflows. That is more than we saw in all of 2024 combined. According to market data, these inflows have happened in 9 out of the last 11 months. And I want to be crystal clear about who is buying. This isn't retail investors getting FOMO or chasing a meme stock. This is institutional money. We're talking about pension funds and sovereign wealth funds, the serious players who move billions of dollars without generating a single headline. They apparently started accumulating this position 9 months ago. You have to ask yourself, what did they see back in March that the rest of the world missed? What data crossed their desks that didn't make it to the mainstream news? Total ETF holdings are now estimated at 1.13 billion ounces, worth approximately $40 billion. Reportedly, that is a record, the highest in history. The last time we saw a record like this was 1979, right before the price rocketed toward $50 and the commodity market imploded. Pattern recognition isn't a conspiracy theory. In this game, it is a survival skill. And right now, the pattern is screaming at us. While Wall Street was obsessed with tech stocks and everyone else was watching crypto, something appears to be breaking in the physical market. The London Bullion Market Association, LBMA, which is essentially the central nervous system of global precious metals trading, used a phrase in November that should have stopped everyone in their tracks. They didn't say the market was tight. They didn't say there were supply constraints. They used the word seizure. Seizure is medical terminology. It suggests a system that is failing, convulsing, and shutting down. We can see the evidence of this in the lease rates. These are the costs to borrow silver for a short period. Reportedly, these rates spiked to approximately 39% annualized. Let that sink in for a second. Banks are allegedly paying credit card level interest rates just to get their hands on metal for a few weeks. Why would a bank do that? Because they may have sold silver they don't actually possess. They sold futures contracts, derivatives, and paper promises. And now, someone is calling their bluff and demanding the real thing. Market data suggests that the Comex had around 130 million ounces in inventory back in 2021. Today, that number is reportedly under 30 million. That is approximately a 78% collapse in just 4 years. To put that 30 million ounces in perspective, industrial demand alone burns through an estimated 700 million ounces per year. If you do the math, 30 million divided by 700 million, you realize that the Comex has enough silver for roughly 2 weeks of industrial consumption. 2 weeks. It feels exactly like a Friday, I remember, where liquidity was low, silver was trading around $54, and suddenly it spiked hard and trading just stopped. They did this to GameStop when retail squeezed the hedge funds. They did it to nickel in 2022 when a Chinese trader couldn't cover his shorts. And now they did it to silver. The lesson here is that you can manipulate paper prices for a while. You can halt trading. You can issue press releases. But you cannot print silver. You cannot create it from nothing. And when paper promises collide with physical scarcity, the paper always loses. Why can't this stop? Why can't the miners just dig more out of the ground? It comes down to a structural deficit. This is reportedly the 5th straight year that silver has run a deficit. That means demand has exceeded supply in 2021, 2022, 2023, and 2024. The projections for 2025 suggest another deficit of anywhere from 149 to 215 million ounces. In a normal Econ 101 textbook world, markets rebalance, prices rise, miners increase production, and supply catches up. But silver doesn't work like that. Industry sources indicate it takes approximately 10 to 15 years to open a new mine. You have to go through exploration, permitting, environmental reviews, and construction before you get a single ounce of production. It is a decade-long process, minimum. The last major silver mine opened around 2019, which was 6 years ago. Here's the problem. Because silver spent the entire 2010s stuck between $15 and $25, miners couldn't justify new projects. Banks wouldn't finance them, so the plans got shelved. Now, even with silver near $60, those projects are still an estimated 8 to 10 years away from completion. Environmental reviews don't speed up just because the price spikes. Community opposition doesn't evaporate. Government bureaucracy doesn't suddenly move faster. This means the supply is essentially fixed until at least 2032. Meanwhile, demand is growing every single year. Solar installations are doubling, EV production is tripling, and AI infrastructure is exploding. And here's the critical part. This demand isn't optional, it is mandated. The US Inflation Reduction Act requires massive solar buildouts. The EU's Green Deal has renewable targets that member states must hit. China is reportedly installing solar faster than the rest of the world combined. These aren't suggestions. They are laws backed by subsidies, tax credits, and penalties for non-compliance. This means solar manufacturers have to buy silver no matter the price. If they don't, they breach contracts, lose subsidies, and face lawsuits. The demand is locked in, contractual, and legally mandated, while the supply appears to be gone. Now, add one more piece to this chaotic puzzle: the Federal Reserve. They are meeting next week. Markets are reportedly pricing in approximately an 89% probability of a quarter-point rate cut. Why does that matter for silver? Because precious metals historically trade inversely to real interest rates. When rates drop, the dollar tends to weaken. When the dollar weakens, commodities priced in dollars typically rise. It is automatic and mechanical. According to reports, Kevin Hassett, a former economic advisor, is being considered for Fed chair. Hassett is known as a dove. He is reportedly in favor of faster rate cuts and more stimulus. If that happens, if the Fed pivots aggressively, the dollar's purchasing power could erode further. And when the dollar erodes, people historically flee to hard assets like gold, silver, real estate, and commodities. Let me show you how this played out before with palladium in 2020. Most people have never heard of it, but it's used in catalytic converters for cars and has no substitute. For years, production was flat and demand was rising slowly. Then COVID hit. Mines shut down, supply chains broke, and suddenly car makers couldn't get palladium. Prices went from around $2,000 an ounce in early 2020 to over $2,100 by March 2021. That is approximately a 45% surge in 1 year. But here's the key. Even after mines reopened, prices stayed elevated. Why? Because once industrial buyers realize they can't trust the supply chain, they panic buy. They stockpile. They secure multi-year contracts at any price. The shortage becomes self-fulfilling. Palladium never went back to $2,000. It stabilized around $2,400 to $2,600. a permanent repricing. Now look at silver today. We have 5 straight reported deficits. Solar is consuming an estimated 350 million ounces. EVs, AI, and military tech all need silver with no substitutes. It is the same pattern, except silver's market is 10 times larger, and the stakes are 100 times higher. This brings us back to Bank of America. In October 2025, they published a significant report forecasting 65 per ounce by 2026. They typically don't make moonshot calls. They are conservative and risk-averse. For them to publish a $65 target suggests their analysts saw something that made caution impossible. They saw the deficits, the inventory collapse, and the inelastic demand, but they also saw capital flows. When institutions like Bank of America publish bullish targets, it is often because their clients are already buying. The research report acts as a justification. It gives pension funds and wealth managers cover to increase allocations. They can say, see, Bank of America projects $65. We're not crazy, we're prudent. Once that starts, more allocations follow, leading to more buying and more supply pressure. Then Citi reportedly followed with a $62 target, then UBS, then HSBC. This isn't just consensus. This appears to be a stampede beginning. And stampedes, once they start, cannot be stopped. Solar manufacturers won't stop building panels because silver hits $80. They will just pay $80. EV makers won't halt production because silver hits $100. They will pay $100. So how high does the price have to go to ration the available supply? Is it $70, $90, $120? We are in uncharted territory, and that is where fortunes can be made. This appears to be a once-in-a-generation supply shock. And supply shocks don't resolve peacefully. They resolve through pain. Someone gets hurt, either the shorts who sold metal they don't have, manufacturers who need metal they can't get, or the investors who waited too long to position. Someone always loses in a squeeze. Here's the reality. If Bank of America is right and silver hits $65 by 2026, that is approximately another 10% from here. Nice, but not life-changing. But what if they are wrong? What if $65 is just the first leg? What if the real repricing happens when industrial buyers realize the Comex is nearly empty and start securing supply at any cost? What if the market goes bidless? No sellers, only buyers. We saw it with nickel in 2022, going from around $20,000 per ton to $100,000 in 48 hours. That was approximately a 5x move in 2 days because someone had to deliver metal they didn't own. Silver's market is bigger and more liquid, but the mechanics are similar, and all the warning signs appear to be there. Backwardation, lease rate spikes, inventory collapse, trading halts. These aren't normal. These are potential endgame signals. But crises create opportunities. If you understand what is happening, you can position for it. Not as a speculator or a gambler, but as someone who recognizes value before the crowd does. Silver at $60 might seem expensive until it is $80, and $80 will seem expensive until it is $120. Because in a true supply shock, price doesn't matter. Availability matters, and availability appears to be disappearing. The people who positioned 6 months ago around $30 are up roughly 100%. The people who position now around $60 might catch another 50% to 100% potentially. The people who wait until mainstream media is running Silver Mania segments, they'll likely be the exit liquidity. That is how these moves typically work. Early adopters win, late adopters chase, and chasers often arrive at the top. The 3 catalysts to watch in the next 30 days are critical. First, the Fed rate decision on December 18th. Markets are currently pricing an approximately 89% probability of a cut. Second, the January options expiry on the Comex, potentially forcing physical delivery. Third, Chinese New Year in late January, when Asian demand historically surges around 40%. 3 events, 30 days, and an estimated 30 million ounces of available supply. I'm tracking this story every single day because silver at $60 may just be the beginning of a much larger shift. A shift in how we value hard assets in an era of aggressive monetary policy. A shift in how we think about scarcity when abundance narratives collapse. A shift in who holds power when the things we need start running out. In my next video, I'm breaking down the exact inventory tripwires to watch. I'll show you the levels that will tell you if this is a bull market or full-blown mania, because there is a difference. And knowing that difference could be the difference between profit and pain. Subscribe right now. Not because I'm selling you something, but because mainstream media typically won't cover this until it's too late. They'll run the story when silver hits $100, when the banks have repositioned, when the smart money has exited. You don't want to be that person. You want to be the person who saw it coming, who understood the fundamentals, who acted on data, not hype. Silver hit approximately $59.65. The supply appears to be gone. Bank of America projects $65, but the physical market may be screaming something louder. It's suggesting that $65 might just be the warm-up. And if you're paying attention, if you're reading the signals, if you're following the money, you already know what could come next.